Welcome back to the Deep Dive. This is the place where we take stacks of source material articles, research foundational texts, and really just extract the essential, actionable insights you need to be truly well-informed.
And today, we are going deep. Our mission is to dissect the fundamental, really the unbreakable relationship between an asset's immediate price.
What we call the spot price or
Exactly, $CV, and its price for guaranteed delivery at some future date, the forward or the future's price, future dollars.
If you look at the screen in a trading room, you just see this massive shifting spread between spot prices and futures prices. It's across thousands of assets. Crude oil, the S&P 500 index, the Japanese yen, gold bullion.
Right.
And at first glance, you might assume that each asset class needs its own complex, bespoke pricing model.
And that's the common misconception. But the beauty of financial engineering, particularly derivative pricing, is its universality. The mission of this deep dive is to prove that those seemingly disparate markets, stocks, currencies, indices, commodities, they're all tied together.
They're all priced using the exact same logic.
The exact same logic. They all speak one unified financial language.
And that language, the key concept that dictates the spread between today's price and tomorrow's price, is the cost of carry.
It truly is the secret handshake of the derivatives trading world. The concept is simple, yet it's incredibly powerful. The moment that spread deviates from the theoretical cost of carrying the asset, smart money steps in.
They just exploit the imbalance.
Instantly.
So let's establish the core intuition for the listener right now. If I buy a financial asset or, a physical good for delivery 6 months from now, why should that price, $700, generally be higher than if I just bought the same thing today, sunny?
I mean, what are the fundamental economic costs being passed along?
Exactly.
The cost of carry is the total net cost you incur to hold or carry the asset over that time period, tourism. Think of it as the price of temporal possession.
Okay.
If you buy the asset today, you have to finance that purchase. So that means you're either paying interest on borrowed money or...
You're losing the interest you could have earned otherwise, the opportunity cost.
Precisely. You're losing the interest you could have earned by just lending that money risk-free. That's your financing cost.
Plus, if it's a physical asset like a barrel of oil, I have to find a warehouse, pay for insurance.
Exactly. You add in storage and insurance costs, then you subtract any income the asset generates while you own it.
Like dividends from a stock.
Dividends, interest, anything like that. The final number, that net cost, is the cost of carry. And this dictates the precise theoretical difference between C&A and home.
So the cost of carry isn't just a predictive tool. It's more like a strict boundary condition, isn't it? If the market observed futures price $5 doesn't equal CDLA dollar compounded by the cost of carry.
Then you have a violation of the no arbitrage principle.
And that's where the big money comes in.
That's the key insight. It transitions from a neat theory into a rule that must be obeyed. Arbitrageurs, operating with nearly unlimited capital and speed, will instantly execute trades that force the observed market price back into line with the theoretical cost of carry.
So if they see a riskless way to profit by exploiting that spread, the opportunity will vanish in milliseconds.
Milliseconds, that's right.
Okay, so to make sure you walk away with a complete framework, we're going to first categorize the assets, then formally define the cost of carry components, apply them to 4 distinct asset classes using a comprehensive framework, and finally,
we'll work through 3 complex numerical cases: a stock, foreign exchange, and a commodity, just to really nail down the calculations.
All right, before we start tallying up the costs involved in carrying an asset, we have to start with the asset itself. Financial theory broadly and critically splits all assets that might underlie a futures contract into 2 major categories.
And this initial distinction is absolutely foundational. It tells us whether the futures price is going to be strictly bound by that no arbitrage principle, or if we have to account for some, fuzzier non-monetary benefits.
And it all comes down to why people are holding the physical asset in the first place.
Exactly, the motivation of the holder.
So let's define them cleanly.
Okay, the first category is investment assets. These are assets held primarily for investment purposes by a significant number of market participants. The main reason for owning them is to secure a financial return, either through income or price appreciation.
Stocks, bonds, foreign currency.
Yep, and critically, certain precious metals like gold and silver.
So if I buy a share of Apple, I'm doing it to get a dividend or hopefully sell it for more later. That's a pure investment motive.
Exactly. Now contrast that with the second category, consumption assets. These are assets held primarily for consumption production or used by manufacturers, consumers, or producers.
Their main purpose is operational, not just financial speculation.
Right. Their primary economic purpose is as an input. We're talking about crude oil, natural gas, heating oil, copper, lumber, agricultural products like corn or livestock. The majority of the physical stock of these assets is sitting in the supply chain, waiting to be processed, refined, or consumed.
Okay, let me challenge that definition a little bit, because this can get murky, can't it? Gold is the epitome of an investment asset. I mean, few people buy thousands of ounces of gold to use it in manufacturing.
Right.
But what about copper? I know copper futures are traded heavily by speculators, so it certainly attracts investment capital. So how do we draw the line? Is it just the predominant use?
That's a great question, and it highlights the need for precision here. It is indeed the predominant use that defines the category. While a hedge fund might treat copper futures as an investment, the existence of the physical copper, the spot market, is overwhelmingly driven by the needs of industrial fabricators, wire manufacturers, builders, and so on.
So the key test is something else.
The key test is the availability of something called convenience yield, which only exists for consumption assets.
So if there are non-monetary benefits to having the physical asset immediately on hand, it's a consumption asset. If the only benefit is monetary return, it's an investment asset.
That's the cleanest way to summarize it. And this distinction really matters because for investment assets, the no arbitrage bounds are very tight and strictly enforced. That usually results in the formula few dollars sells as the ACT.
But for consumption assets?
For consumption assets, we introduce the complexity of the convenience yield, which we call U dollars. And that means fee dollars can actually be lower than the compounded cost of carry.
Okay, let's unpack this a little. The core mechanism that keeps investment asset prices in such tight alignment is the ability to short sell, right? That's what allows arbitrageurs to enforce those rigorous no arbitrage bounds.
The short selling mechanism it's like the financial guarantor of the futures market for investment assets. If the futures contract is overpriced relative to the spot price plus the cost of carry, an arbitrager needs to be able to synthesize a long position in the future by selling short today.
Can you walk us through that process again? Let's focus on the obligations the short seller takes on.
Certainly. Short selling involves 3 steps. First, you borrow the asset, typically from a prime broker. Second, you immediately sell that borrowed asset in the spot market, getting cash today, $7.
And then you wait.
And then, at a later date, you buy the asset back to return it to the lender, hopefully at a lower price.
The expectation is that the price will fall, giving you a profit.
That is the speculative motive, sure. But for arbitrage and the cost of carry model, the crucial element is the financial obligation. The short seller must pass along any cash flows, like dividends or interest, that the asset generates while it's on loan.
Why is that?
Because the original lender of the asset, who is now temporarily without it, still expects to receive the economic benefits of ownership. They need to be made whole.
And this detail is what makes the cost of carry calculation so precise for, say, dividend-paying stocks.
Precisely. Let's use the specific cash flow example from the source material to make this crystal clear. Suppose an investor shorts 500 shares in April at a spot price of $120 per share. A $1 dividend is paid in May. The investor then closes the position in July by buying the shares back at $100 per share.
So in April, the short sale happens. The investor gets cash immediately. 500 shares times $120, which is $60,000. That's a big cash inflow.
It is, and that cash inflow is usually invested, typically earning the risk-free rate, which is why that rate, $3, is a core component of our model.
Then May comes around, dividend payment time.
The short seller has to cover that. They pay the lender $1 per share for 500 shares, so a cash outflow of $500.
Not to keep the lender whole, as you said.
Right. And finally, in July, the investor buys the shares back. A cash outflow of $50,000. That's 500 shares at $100.
So the net cash flow is $60,000 minus $500 minus $50,000, which is a profit of $9,500.
A nice profit. But the critical point for our futures pricing model is this. The short seller had full access to the $60,000 initially, but was obligated to pay the dividend.
And that obligation to pass along the dividend perfectly mirrors the income adjustment, tuberculars in the cost of carry formula.
Exactly. And we should also mention the margin requirement. All these short sales happen in a margin account. The broker requires the investor to deposit cash or collateral, the initial margin, as a performance bond.
It's not to pay for the shares, it's a guarantee.
It's a guarantee that the short seller won't default if the stock price skyrockets. It ensures the whole arbitrage mechanism remains riskless from the broker's perspective.
So the availability of a liquid short-selling market for investment asset is the ultimate guarantee that the cost of carry determines the futures price. If the futures price deviates, the arbitrage mechanism just snaps it back into place.
Now that we know what we're carrying, we can formally introduce the cost of carry, $2. This rate, expressed annually, is the exponent that mathematically connects the spot price, C dollars, to the theoretical futures price, $5. It is the universal language we promised.
The beauty of this is how it distills all this, real-world financial friction into a single net rate. Remind us of the formula again, $, R plus UQ. Let's just spend a moment defining those components.
Absolutely. The first component is interest. This is the single biggest determinant of the cost of carry for financial assets. We assume that any arbitrage transaction uses funds borrowed or lent at the risk-free rate.
Why risk-free?
Because the arbitrage trade itself is riskless, it's locked in. So the opportunity cost of capital must also be risk-free. It reflects the return you could get on, say, government securities over that time horizon, $2.
And this dollars is positive. It's a cost. It's the cost of funding my long spot position or the income I earn if I short the asset and invest the cash.
Correct. Either way, $3 is the opportunity cost that must be compensated for in the futures price.
Okay, next up is storage costs. These are the practical, real-world expenses: insurance, warehousing fees, security.
Yep. And $2 is typically only applicable to physical commodities and certain precious metals like gold bullion that need secure vaulting. For financial assets, stocks, currencies, indices, $0.
But for crude oil or grain, it could be substantial.
Oh, absolutely. It can be a significant positive number, increasing the cost of carry.
Finally, we subtract income. So this is the income generated by the asset during the holding period. Dividends on stocks, coupons on bonds.
Or foreign interest rates, as we'll see. This component reduces the effective cost of carry. If I hold an asset and it generates income, that offsets my financing cost, $2.
Okay, now let's talk about the math for a second. You mentioned we assume continuous compounding. Why is that the standard in derivatives pricing? Why not just use, I don't know, daily compounding?
That's an important technical point. In modern finance, continuous compounding lets us model the exponential growth of money over time as a smooth, constant process. It just simplifies the derivative formulas considerably, especially when you get into options and volatility. The formula assumes that everything is accrued and reinvested instantaneously.
It's a cleaner mathematical representation.
It's the gold standard for defining theoretical parity. If we use discrete compounding, the exact value would depend on the frequency daily, monthly, and that would just introduce unnecessary complexity.
Okay, so with those variables defined, let's revisit the two big generalized formulas that unite all futures pricing.
For a straightforward investment asset, where there's no non-monetary benefit to holding it physically, the formula is $50 ECTT.
Where $0 is that net cost of carry, a hard boundary.
Right. And if $50 doesn't equal this number, arbitrage is possible. But for consumption assets, where that non-monetary benefit, the convenience yield, comes into play, the formula is adjusted. SC dollars equals ECYT.
So the convenience yield acts like a benefit that reduces the effective cost, pulling the futures price lower than the financial costs alone would suggest.
That distinction is absolutely critical. It's what separates markets like the S&P 500 from the market for a barrel in crude oil.
Here's where it gets really interesting. We can now take that universal formula, SOPAS ILE's R plus UQ2, and populate it with the specific financial terms for each major asset class. This is where the abstract theory becomes a practical pricing tool.
Think of this framework as a Rosetta Stone for futures markets. You look at the asset, you identify its unique components of $2, and a $, and you immediately know its theoretical price structure.
Okay, let's walk through it. Let's start with the simplest case, a non-dividend paying stock.
Right. For non-dividend stock, storage is 0 and income is 0. So the cost of carry, C dollars, is simply equal to 3.
The risk-free interest rate.
Just $2. So the formula is COSE or STT. The futures price is determined purely by the opportunity cost of capital. The buyer compensates the seller for the interest the seller lost by holding the stock instead of just lending the money.
Simple enough. Now, what about a stock index like the S&P 500 or a stock that does pay a dividend?
Here, the income component, $2, comes into play. The cost of carry becomes CSRTT. Interest cost is offset by the dividend yield.
So the formula becomes $0 is SARQT.
Correct. The aggregate dividends you receive reduce your net expense of holding the basket of stocks. So this offset ensures the futures buyer gets a lower forward price to compensate them for not receiving those dividends.
So if the risk-free rate is, say, 5%, but the dividend yield on the S&P 500 is 2%, the cost of carry, C dollars, is only 3%.
Exactly. The futures price will be lower than if there were no dividends.
Okay, now let's move to foreign exchange, or FX. The logic is the same, but the labels change. Here, Forey-Sire equals RRF1. This is a big one. Interest rate parity.
It's a cornerstone of international finance. When you carry a foreign currency, say the euro, you're involved in two separate interest rate environments.
Right.
To buy the euro spot, you either borrow your domestic currency, let's say US dollars, at rate $2, or use USD you could have lent at rate $2.
And at the same time, once you own the euros, you can deposit them and earn the foreign risk-free rate, or dollars.
So you pay $12 and you earn dollars. Your net cost of carrying the foreign currency is the difference, TOR RF1.
Which means if the U.S. interest rate is higher than the Eurozone rate, it costs you money to hold euros.
It does. And so the forward price must compensate you for that cost. The euro must trade at a premium to the spot price. And this is absolutely enforced by something called covered interest arbitrage. If the forward price doesn't reflect that rate differential, a trader can lock in a riskless profit.
That's a phenomenal example of arbitrage enforcing the cost of carry. The smallest difference between $3 and dollars has to perfectly determine the movement from C dollars all dollars.
It must. It's one of the most theoretically pure relationships in all of finance.
Okay, two more. What about investment commodities like gold? Gold doesn't pay a dividend, so a collar is zero. It's not really consumed, so we'll say YEL is zero. What's left?
You're left with Hogel-Lawler plus U-ELIC. The cost of carry for gold is the financing cost, $3, plus the vaulting and insurance cost, $2. These storage costs, while small on a percentage basis, are not zero, and they have to be included.
So the formula is SRAER plus UT.
That's right. If you hold gold, you are losing the interest, and you're paying the storage cost dollars. The futures price must therefore be higher to cover those combined expenses.
And if the futures price for gold were, say, lower than that, what would happen?
Arbitragers would immediately buy the undervalued futures contract and simultaneously short the physical gold. They'd profit from the futures price being too low relative to the cost of carrying the asset. That pressure instantly brings the futures price back up.
Finally, that leaves us with consumption commodities. Copper, oil, things like that.
Here we have all the direct cost financing and storage, but they're reduced by that non-monetary benefit, the convenience yield. So the effective cost of carry is DR plus GYR.
And the formula becomes $3 is SER plus EYR. The futures price is suppressed because of the value of having the physical asset available for immediate use.
It's like an insurance policy against a shortage, and that insurance has value.
Theory is essential, but application really locks the knowledge in. We need to transition from the algebra to the arithmetic. Let's walk through 3 distinct numerical examples.
Sounds good. And remember, we are assuming continuous compounding for all these calculations, which is the standard in derivative valuation.
Okay, mini case number 1. A stock with a known discrete income stream.
All right. The scenario. A stock is trading spot, C or dollars, at $100. The annual risk-free rate, $3, is 5%. The time to maturity, $2, for our futures contract is 1 year. And crucially, the company has declared a guaranteed cash dividend of $2 payable in 6 months, so that's 0.5 years.
Okay, so this isn't a continuous dividend yield. It's a specific one-time cash payment. We have to account for that differently, right?
That's right. The first step is to recognize that the person buying the futures contract does not get that dividend. The future seller keeps it. So in compensation, the price of the futures contract must be lower.
So we have to calculate the present value of that known dividend. We call it all dollars.
Correct. We use the present value formula discounted at the risk-free rate. So $2 times E.05 times 0.05.
Okay, so that's e to the power of negative 0.025, which is about 0.9753. So $2 times that gives us about $1.95.
$1.95. That is the financial adjustment required. The future seller gets to keep that dividend, so the price of the stock must be hypothetically reduced by $1.95 before we do anything else.
Right, so step 2. We apply the known income formula where we adjust the spot price by I dollars before compounding the rest by the interest costs.
The formula is $THID IRT.
So that's $100.95, which is $98.05, and we multiply that by E dollars and 5 times.
Or EF5, which is about 1.05127.
So $98.05 times 1.05127 gives us approximately $103.07.
The theoretical no arbitrage futures price is $103.07.
Okay, let's pause here. Let's dissect the implications. What if the market were pricing the one-year future at, say, $104? How would a trader exploit that 90-something cent discrepancy?
Okay, great question. If the observed futures price is $104, it's too high relative to our theoretical price of $103.07. The market is overpaying to defer the transaction, so the arbitrager needs to create a synthetic short future.
So the trade is buy low spot, sell high future.
Exactly. Step 1. Borrow money for 1 year at 5% and buy the stock spot at $100. Step 2. Short the futures contract at $104.
Oh, you're locked in.
You're locked in. Step 3. You wait 6 months. The stock pays that $2 dividend, which you collect. You can use that to partially pay down your loan. Step 4. At maturity, in 1 year, you deliver the stock you bought, fulfilling your short futures contract, and you receive $104.
So let's trace the cash. You pay $100 today. You get $104 in 1 year plus the $2 dividend. Total future cash inflow is $106.
But you have to pay back the loan. $100 borrowed for a year at 5% continuously compounded is $105.13. So you received $106 and you paid back $105.13.
That's a guaranteed riskless profit of 87 cents per share.
And the moment the market realizes this, the rush to buy spot and sell futures will compress that spread until the futures price drops right back to $103.07.
Mini case number 2, foreign exchange.
Next, we move to currencies, where the cost of carry is all about interest rate differentials.
Yes.
The scenario. The current spot rate, CVOTers, is 1.2500 USD per UR.
So our domestic currency is the US dollar.
Right. The domestic interest rate, USD, 4%. The foreign interest rate, EUR, 3HFI, is 1%. And the time to maturity, $2 is 9 months, or 0.75 years.
Okay. The cost of carry for FX, CFT, is the differential. 1 CFE is our RFE. So that's $0, $4.01. Our equals is 0.023 or 3%.
That 3% differential is the net cost of carrying the euro, financed by the U.S. interest environment. So we apply the currency pricing formula, FIABA, SCOT-FAT.
Okay, so that's $1,250 times 0.0272500, 0.016 of 500. And that comes out to about 1.2784 USD EUR.
The theoretical forward rate is 1.2784. So the euro has to trade at a forward premium against the dollar. Why is that? What's a fundamental economic reason?
It's because the domestic interest rate, the US dollar rate at 4%, is higher than the foreign interest rate, the euro rate at 1%. If you hold euros, you're only earning a paltry 1%, while you're simultaneously giving up a 4% return available in dollars.
So to compensate you for that lower earning power, the forward price of the euro must be higher. The euro needs to appreciate by precisely 3% per year, compounded continuously over those 9 months to offset the interest rate disadvantage.
Makes perfect sense. Okay, let's do the arbitrage trade again. What if the market observed a 9-month forward rate of, say, 1.2650? That's significantly lower than our theoretical 1.2750. What trade forces that price back up?
Okay, so the observed forward price of 1.2650 is undervalued. The market is mispricing the return difference. The arbitrage opportunity is covered interest arbitrage.
Walk us through the steps. The EUR future is too cheap, so the trader wants to buy it, right?
Synthetically, yes. So step 1, borrow foreign currency. You borrow euros today. Since the foreign rate is low at 1%, this is cheap. Let's say you borrow 1 EUR.
Step 2.
Convert to domestic. You convert that 1 EUR immediately at the spot rate of $1,250 into 1.25 euro USD.
And then you lend that out at the higher US rate.
Exactly. Lend domestic. You invest the 1.2500 USD at 4% for 9 months. And at the same time, you lock in the future rate by entering a forward contract to sell the USD proceeds back into EUR at that undervalued forward rate of 1.2650.
Okay, so after 9 months, the trader has accumulated, let's see, $1,250 times 0.4 times 0.75 Nella. That's about 1.2881 USD from their lending.
Correct. They use that 1.2881 USD to fulfill their forward contract, selling USD and buying EUR at the rate of 1.2650. They end up with 1.28801 divided by 1.2650, which is about 1.0183 EUR.
And their original obligation was to repay the 1 EUR they borrowed, which is compounded at 1% for 9 months. That repayment is $1 times 0.01 times $0.75, which is about 1.0075 EUR.
So the trader's left with 1.0183 EUR and only needs 1.0075 EUR to pay back the loan. The difference to about 0.0108 EUR is a riskless profit.
And the collective effort of traders doing this simultaneously drives that forward price up until the interest rate differential is perfectly reflected at 1.2784.
That's the market in action.
Okay, final case. This is the one that introduces that extra layer of complexity. A consumption commodity with convenience yield?
The scenario. Copper. The spot price, $3.40 per pound. The risk-free rate, $3 is 6%. Storage costs are 2% annualized. The time to maturity is 6 months or 0.5 years. And we estimate the convenience yield to be 1.5%.
Okay, step 1. Calculate the total direct cost of carry. $, has no income, so $2 is 0.
So $0 plus U equal 0.06 plus 0.02 equals 0.089 or 8%.
And if copper were like gold, a purely investment asset, its theoretical forward price would be determined solely by this 8% cost. That would be $3.40 times 0.08 times $0.5, which comes to about $3.54.
$3 of 5 farce 4 cents is the price ceiling imposed by financing and storage alone. However, copper is a consumption asset, and we have that estimated non-monetary benefit, the convenience yield of 1.5%.
Right, so step 2, we calculate the effective cost of carry, incorporating that yield.
It's $1.015, math BF 0.065 or 6.5%.
Okay, and step 3, we apply the consumption asset formula. $5 is SEYTAT.
So $5 is $3.40 times E.065 times 0.4.
That's E.0325, which is about 1.0330. So $3.40 times that is approximately $3.51.
This is 51.
So the convenience yield pulled the theoretical forward price down from $3.54 to $3.51. That 3-cent difference represents the market's valuation of the operational benefit of having physical copper now.
That's the key. Someone who buys a futures contract at $3.51 is giving up that 1.5% annual insurance value they would get from having the physical stock on hand. The cost of carry tells us the total financial and storage cost is 8%, but the operational benefit offsets that by 1.5% for a net expense of 6.5%. This is why commodity pricing can be so much more volatile than financial assets.
So what does this all mean when we talk about the practical behavior of commodity markets? This convenience yield seems to be the greatest source of analytical complexity. It's totally intangible, yet we can measure its impact in dollars and cents.
The convenience yield is perhaps the most fascinating component because it represents the market's assessment of supply chain risk and operational efficiency. It's the benefit that accrues only to the holder of the physical commodity, not the holder of the paper futures contract.
Give me some concrete examples of that benefit. What exactly is a manufacturer buying when they pay a premium for spot copper or spot crude oil?
They're buying insurance. They're buying the ability to keep their manufacturing line running continuously. If a sudden local supply disruption occurs, the person holding physical inventory can profit massively by just continuing production or selling that inventory at a temporary spike price.
So they have flexibility, insulation from short-term chaos.
Exactly. The futures holder only has a guaranteed price for a future date, which offers no immediate operational benefit.
So convenience yield is essentially the subjective value assigned to holding that operational insurance.
Exactly. And the most significant factor driving this value is the level of physical inventory. We observe a powerful inverse relationship. Convenience yield and inventory levels move in opposite directions.
So if inventories are high, say, global crude oil tanks are nearly full, the risk of a sudden shortage is minimal. The insurance value of holding extra inventory just drops.
Correct. When inventories are ample, the convenience yield, YALARS, is low, often near zero. When your YALARS is negligible, the market reverts to acting like an investment commodity, and the futures price adheres closely to the full cost of carry. $50 is approximately Z1I plus U2.
And that market situation where the futures price is higher than the spot price, dictated purely by the positive cost to carry, is called contango. It's the normal state for investment assets.
Now, consider the opposite. Inventories are low. Perhaps global copper stockpiles are dangerously depleted, or there's geopolitical risk threatening a major crude oil shipping lane.
The market is nervous. The risk of a shortage is high.
And in this high-stress environment, the insurance value of holding physical stock, the convenience yield, shoots up dramatically. In fact, YALARS can become high enough to actually offset the total financial and storage cost of carry.
And when the ALRS is high enough to offset ALRS, meaning FALRS is less than nominal, what happens to the futures price?
If the effective cost of carry becomes negative, the pricing model dictates that the futures price must be lower than the current spot price, $5. This market situation is known as normal backwardation.
Normal backwardation is where the futures curve is downward sloping. The longer the maturity, the lower the price, which tells us the market is placing an enormous value on immediate physical access.
We saw this dramatically play out during the COVID oil crash in early 2020. The problem wasn't a lack of oil, it was a lack of physical storage capacity. When the tanks were literally full, the convenience yield vanished. There was no benefit to having more oil today if you couldn't put it anywhere,
And without dollars to suppress the price, the high positive storage costs, SIG dollars, and dominated everything.
which led to extreme contango, and famously, futures prices briefly went negative. That event really highlights how the cost of carry, particularly storage dollars and convenience yield dollars, can dominate all other financial factors when physical constraints are reached.
It forces you to understand the difference between the paper market and the physical supply chain.
Indeed. For investment assets, the cost of carry creates a tight equality. Fee dollar equals SET. For consumption assets, the price reflects that operational premium, free dollar, which often results in $6 ET. Understanding if a market is in contango or backwardation gives you immediate insight into the physical inventory conditions and the operational anxiety of that market.
We started this deep dive looking for the single unifying architecture behind futures pricing, a conceptual gravity that dictates the movement from spot price to forward price across currencies, stocks, and commodities. And we found it firmly rooted in the cost of carry.
That concept, defined simply as interest cost plus storage cost income received, is the financial backbone of derivatives markets. It's the language that arbitrageurs speak to enforce market efficiency.
The great realization is that the core structure is constant. The complexity only arises when you accurately define the financial variables that fit into that universal framework for each asset, and when you identify whether the asset has that non-monetary benefit, the convenience yield.
The ultimate lesson is that whether you're trading a stock index future or an orange juice contract, every asset has an intrinsic cost to hold, and that cost fundamentally dictates its theoretical value tomorrow. The cost of carry ensures that, in an efficient market, you cannot get the same asset for cheaper tomorrow than the cost required to carry it.
So in pricing a futures contract, we establish the formula must generally hold. Fate dollars SO Rorolsky 0 at ECY OCYT. Let's revisit an extreme scenario. If you observe a consumption commodity futures contract where the market price is much higher than the theoretical price, what specific strategy must traders execute to force that misaligned price back into equilibrium?
That's the ultimate test of understanding the no arbitrage principle. We've established that for consumption assets, Yarmanas must typically be zero or positive. So if the futures price is excessively high, it implies the market is pricing in a theoretical negative convenience yield, which is nonsensical. It means the forward is grossly overvalued relative to the spot.
Which means the arbitrager has to exploit the overvalued future and the undervalued spot.
Exactly. The key insight is that the arbitrager must always execute the transaction that restores the cost of carry relationship. The trade involves the core economic function of inventory, carrying the asset forward in time.
So the arbitrager must buy the physical spot commodity, which raises the spot price, and simultaneously short the futures contract, driving down the futures price.
And finance and store that purchased inventory for the life of the contract. This action guarantees a riskless profit well above the cost of funding and storing the asset, and the simultaneous buying of spot and selling of the future forces $U down and seller up until the difference exactly equals the cost of carry. The resulting profit is the reward for restoring equilibrium. The cost of carry isn't just an equation, it's a dynamic force, constantly policed by the market itself.